Good afternoon, everyone. Welcome to the MICPA's PPP2 lunch break. This is a follow-up to our roundtable from January 5th. We have a few more people trying to get in, so we're going to just wait a minute and then begin the program. Before I do so, I'd like to do a little housekeeping. Just to let you know that if you weren't able to attend the program on the 5th, that those resources are available on the MICPA website. We have a conversation going on MICPA Connect, which I will share in the chat. I would ask everybody to look at their chat feature. We'll be communicating questions through there. Everyone is muted, but you can ask your questions of the panel through the chat feature, and we will be posting some information in the chat throughout the program. Okay, so without further delay, I would like to introduce our panel. We have Leon Lebrecq, Chief Growth Officer for Sequoia Financial, Jamie LaPiccolo, Capricorn Professional Advisors, and Bob Wines from Insight 3 Advisors. So without further ado, gentlemen.
Great. Hello, everyone. And Bob and Jamie, good to be with you today. And I'd like to thank our sponsors today, too, as well. Jim, did you want to mention our sponsor? Or?
Yes, we have CPA.com here. We have Brian Sight joining us. Brian's going to speak for a few minutes at the end of the program with some resources that they've put together that you would probably be very interested in.
Great. So we do want to thank CPA.com, and that's terrific. So my illustrious colleagues, it's good to have the band back together again. I'm Leon Lebrecq, and most of you unfortunately know me from my days of torturing you as a student at Walsh College or wherever, or listening to my tedious seminars. I'm here with Jamie LaPiccolo, one of my favorite CPAs, who Jamie and I share some clients and actually luckily live close to each other. And now now that this COVID's coming off, as soon as February 1st hits, I'm grabbing Bob and Jamie, and we're going to do our next session for you from a real bar. I think we're going to do that. Bob Wines, JD CPA, Insights 3, friend of mine from Plant Moran days from 100 years ago or 1,000 years ago when Frank Moran was still around. Bob and Jamie, great to be with you guys today, and great to have you. And we get to go on the newest range of specialization that we get to be in on. We get to talk about the specialty all of us have for the next 60 days and new stimulus and give us PPP2 or something. So I thought we'd go from there. And I thought we'd like to talk about some of the overview of the recent stimulus and guidance. And those of you who've been on our other roundtables, you see what happens when you give a bunch of nerds time. They start making slideshows out of the whole thing. So we now have a slideshow to share with you. So I thought we would just go through some of the timeline. Obviously, we had the CARES Act signed into law for the Paycheck Protection Program, which was then followed by what seemed like an endless round of SBA modifications, leaving us into distraction and insanity. Finally, on December 27th, they came up with the new Consolidated Appropriations Act, which I think could be the Continuous Employment Attorney and Accountant Act, created the PPP2, and as I like to say it, the world's biggest punch bowl full of Ron Rico 151, in which we can do EIDL loans, employee retention credits, PPP1 and PPP2. So just when you thought it was safe to go back in the water, now we have way more things we can talk about. We've gotten some new regulations. We've gotten the new second draw loans. We found out some really interesting things, and I'm going to ask Bob and Jamie to chime in on those things. So Bob, you want to take a little overview and throw us onto the CAA 21 and tell us what's going on?
Sure. Just from a real big picture, really what we've got right now is a PPP2 we're going to look at today. We're also going to look at the employee retention credit. We've got basically $285 billion of PPP. According to the AICPA study last week, the funds are not draining as quickly as they feared they might. So if you're talking to your clients, even though they reopened the portals a couple of weeks ago, it's not the fire drill. So I think you've got time for your clients to apply. And then regarding the employee retention credit, again, I would say on that, and we'll hit this later, I would get your PPP loan, your first draw loan, if your clients have not applied for that already. And if they qualify for a second draw, I would get that in. Then I would take my time and look at the employee retention credit. I would not apply for forgiveness for your first PPP loan until they've clarified the rules for the employee retention credit, and we'll hit that later. There's some excellent reasons to postpone for a bit. Why don't we jump to the next slide?
So let's go to second. This is PPP2, so fire away.
Okay, PPP2, what I'm doing is these slides will all be available to you, but we don't want to go through a real detailed re-explanation of the rules, which we hit at our last roundtable. So let's just highlight the most important things. For PPP2, you only have to have if you have 300 employees or less, you can qualify. You must also show that you got a reduction in your gross receipts at least 25% for any quarter in 2020 compared to the same quarter in 2019. So 300 or less employees, you probably qualify. If in any quarter you've got a reduction in gross receipts of at least 25%, you're good. Even if the other 3 quarters were record quarters for you. So your client should then be considering applying for a second draw loan. Next slide. Eligible borrowers, we'll get this out yet. I got to start drinking.
First day with the new teeth, eh?
Yeah, that's it. Oh, it's really fun. It's the same list we had before. For most of us, I just highlighted the additions. If you've got housing cooperatives, 501c6 organizations, destination marketing organizations, and certain news organizations, they qualify. It's worth looking at the rules if those are your client base. Otherwise, the clients you had for PPP1, they qualify for PPP2. Next slide.
Hey, Jamie, you lit up my eyes this morning with an email about the 50,000 or less, one of the new regs that just came out on that. You want to share that with everybody?
Yeah, so that I think that's going to be later in the slide, but the as I was going through this, they upped the forgiveness to 150, made it very well much easier for borrowers under $150,000, but they still left in that $50,000 rule, and they applied it to all of the FTE exceptions. And now that if you borrowed under $50,000, it doesn't matter where your FTE count is, you're automatically forgiven. So it gives the smaller borrowers basically complete forgiveness on this, regardless of their employee count at the end of the year.
Right.
Yeah.
You don't even have to show anything, right?
No, I was surprised to see that come through, but no, I don't think. I think you maybe have to do some certification still, but it's a safe harbor now, essentially, right, Bob? I mean,
it is. Yeah. And we'll hit this later, but you file a 3508S, which is literally a 1-page, well, kind of 1.5-page form, and you're done. I mean, at that point in time, you're exempt from the wage requirements. So if you cut wages, it's fine. You're exempt from the FTE requirements. So if you had to lay off people, you're fine. Now, the thing not to get mixed up, which I did many times, is that you can use the 3508S, which is a simplified form for forgiveness if your loan's 150,000 or below. You can only get waiver of the FTE and the wage reduction rules if your loan is 50,000 or less.
Right. So, right. And I think that's where the confusion is, right? Is that the 150 is the new ceiling for the simplified form, but the $50,000 remains the level for being able to exclude your FTE calculations or exempt from the FTE and the wage restrictions or reductions.
Yeah.
So it's kind of a 2-step process for people, or two-prong approach.
Yep, it is. Now here's our ineligible borrowers. Never mind. You know who I mean. These are the people who don't qualify.
The ones who can't get it. Here's
That's
who
right.
can't get it.
Yeah, exactly.
What Bob's trying to say.
It's not enraged political activities. It's political. So if you've got an organization, a 501c6 or something else, you say, oh, good, but they're involved with lobbying or political activities, not going to qualify. The other thing you might run into, if you have anyone who qualifies for the Shuttered Venture Operators grants, you can't get both. So take Shuttered Ventures or Shuttered Venues, or take the PPP2, but you don't get both. The
Right.
other ones are, you know, if you're dealing with China, or if you're a public corporation, or if you happen to be the president, blah, 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 you have to, then there's exceptions for those too.
Hey, Bob, there's a question that came through that you and I were talking about this before we started, but one from Dan says, did you say the employees paid through an employee leasing company, PEO, count as wages for the loan amount? And you and I had a little bit of a conversation about that, and I believe that those rules didn't change under the new law, and the PEO, it still goes to the individual company that's actually leasing the employees.
Yes.
So the PEO itself does not apply for the PPP. It's the companies that they're leasing the employees to, and they have to submit, and I apologize, I don't do any PEOs, but there's a special equivalent of the 941 that they have to schedule, that they have to submit as part of the proof of the employment.
Yeah. So the
So-
PEO does not mean you don't get it. So
Right. It's just a matter of who gets it.
Yep. Hey,
Hey guys, do you want to cover the shuttered venue operators? We did have a question on that too, because if you
Yeah,
got a
I
shuttered
thought
venue
that was later in the
operation-
presentation, but yeah.
Okay, all right. Well,
That's-
Jamie, you want to hit on some of the that have more than one location, like restaurants?
We're
Yeah.
gonna do that right now.
Yeah, there you go. So
What a segue! What a segue!
there you
Wow.
go. So
Fancy that. What a segue.
So this is the new PPP2 allows for those that have an NICS code 72, which are generally your restaurants and hospitalities to qualify for this, for a second draw with no more than 300 employees for physical location. But they also still have to follow the revenue test, and I believe that the maximum loan on the consolidated is up to $4 million though. So I don't think that they can get multiple $2 million loans. I think it's still maxed out, and then the owners still have to be just across to one. So there's some limitations there, and also some new is news organizations which were not in the original can qualify, and those have the NIC code of 5151. There as well.
Yeah. So those are outside. They're exempt from the affiliation rules.
Yeah.
Now for the gross receipts, what we really got here is just keep in mind the gross receipts have to fall at least 25% in any quarter of 2020 compared to the same quarter in 2019. If you've got clients who don't do quarterly, you can use their tax returns. So you could say, here's the 2019 tax return compared to the 2020. Haha, like we've got our 2020 tax returns done yet.
I'd like to take a poll of the CPAs on here. How many clients have asked for their 2020 already to be done?
Yeah. On January.
But if you're in fairyland, that's perfect. You can just do that. There is an interesting little dichotomy. What happens if you happen to be using, because keep in mind, all these gross receipt tests, et cetera, typically are looking at calendar years they're looking at. What happens if you're reporting a fiscal year for your tax returns? Who knows? But long and short of it, the tax returns really aren't going to apply to us because no one's going to have those done. So it's just look at your calendar quarters and just, pop those out and compare them to the 2019 calendar.
Right,
quarter.
and there's a couple little, and I don't know if we're going to cover, there's a couple little caveats. I think somebody asked a question here, can you use the accrual or cash for the termination or loss of a quarter? If you file your taxes on a cash basis, but use accrual to determine MDOT reimbursement under fair regulations, I think that the corporate tax return is going to rule because they're going to ask for, as part of the demonstration of gross receipts, they've been asking for the corporate return or the business return. So I think your business, whatever you do for your corporate return, is going to rule there for that. So, and then the other thing, I think that Bob, I don't know if you've addressed that in here, but I saw that as part of the SBA regulations, if you've got over $150,000 and you have to provide documentation of gross receipts, you're going to have to sign off on the financial statements. You're going to have to sign a positive affidavit relative to the accuracy of the financial statements.
Yeah, and we'll hit that. There was a question
If it's under 150, you have to prove it later.
At some point in time, yes, either at the application or later. Yep.
Yeah, and even if you're under 50, keep in mind, it doesn't mean you don't have to prove that you qualify for the second draw loan. you don't have to prove you're exempt from the wage reductions in the FTE tests for forgiveness, but you still have to show that you qualified. So
Right.
you don't get away from that rule no matter how big or small your loan is. There was a question that popped up which was saying, how about if I have a fiscal year taxpayer? This is very common, especially let's say in a nonprofit world. And can we use the fiscal quarters? To be candid, I've looked at that. I am not clear. If you could use calendar year, I would recommend it because I think you're going to get phenomenal pushback from the banks.
Yeah.
To educate them that no, we arguably could use fiscal year 2020 compared to fiscal year 2019. I just don't think I would go there.
The only place that I saw the fiscal years to be able to, and this is out of an SBA, one of their second draw, how to calculate the revenue and maximum loan amounts that they issued on January 19th. They indicate somewhere in there relative to fiscal years to be used for the annual test, because you can always provide an annual test of decrease, because the argument is if you have an annual decrease of 25% or more, then every one of your quarters is at least 25%, just the law of averages. But I think what they're saying there is you can use a fiscal year for that, but it's got to maintain, it's got to be in, right there through it's got to be in certain quarters. You still have to, the quarter end has to end in one of the quarters, I think it is.
Yeah.
So that's the only reference I've seen to fiscal years, Bob.
Okay. Okay. My advice would be, because I've got a bunch of nonprofits who are asking us, I'm simply saying, folks, if we want to get this through, we're having enough problems with the banks already. I'm not going there if I don't need to. So if you don't need to go there, my attitude is just don't. The gross receipts test, what's included under this new rule? They've added something for nonprofits. The gross amount received from sale of assets without a reduction for basis or sales expenses, that's what's included. So if they're selling an asset for $100,000, that $100,000 is in their gross receipts. So now keep in mind, if you're a for-profit business, that's not true. Because for for-profit businesses, if you look at this, what's not included? Net capital gains or losses. So if you got a net capital gain or loss, that's excluded from your gross receipts. So there's this dichotomy.
I think farms can use gross receipts too.
Yeah, it could well be. I have not.
Yeah, I'm almost certain. I'm certain a farm can use the gross receipts test, and 25% reduction in gross receipts on a farm works. Pretty sure that.
Now, the rents thing, Jamie and I had a conversation earlier. Jamie, why don't you bring this up, because it's a good point, where they're saying, okay, let's assume I own an S corp or whatever, and I also own the building outside of the corporation, and I'm charging it rent.
Yeah,
Would
so
I have to group myself in, include my rents as part of my gross receipts because I'm an affiliate?
Right. I think there was a little bit early on, and I thought I saw a thing on Connect regarding affiliate rules and how do affiliate rules come into play into this. And so the question was, do the affiliate rule, gross receipts of the affiliates, especially in a rental situation, add to the gross receipts of the organization for termination of gross receipt reductions? And the SBA came out on that January 19th ruling and basically said that proceeds from transactions between a concern and its domestic or foreign affiliates are not included as part of the gross receipt. So I think that just makes sense from basic consolidation rules and so forth. Chances are that the rental property is not going to be eligible for the PPP on its own because it probably doesn't have any wages. Typically they don't. So I don't think that you're going to you would include those rents as part of under the affiliation rules.
Yeah.
Hey guys, what about grants? I know we don't include PPP as one of the. What happens with? What do you think if you got a grant from like Oakland County? Where would that go?
If you're a nonprofit and you get a grant, it's included. If you are a for-profit and you got a grant, I think it would be included unless we're treating it as a PPP forgiveness. I'm
thinking like an Oakland County grant or a Wayne County grant. We've had a couple of questions on that.
Yeah, I can't find anything on those types of grants that say they are not included.
Yeah, I would follow again, they're following the definition, to me, they're following the definition of your tax return rules. So if it's included in gross receipts as part of your tax return, which I mean, granted, it may be other income, but it's still part of your gross receipts. So if the grant is taxable, then I think that it's included for profits. They specifically, address the PPP not to be included, but I think the grants would be included in gross receipts.
Yeah, yeah, and they definitely are for nonprofits.
Well, because it shows up on their 990, right? On the nonprofit, a grant shows up on their 990. If it shows up on your 990, it's there.
Yep, it is, and that included if you've got mission related for billable work, etc. That's all included.
Yeah.
Okay.
Yeah. The only thing that they address in their regulations or their rules is the PPP loan proceeds, so that are forgiven. So those are the only one that they really addressed relative to that.
Yeah. The big things for me were, capital gains or losses, exclude them from gross receipts if you're a for-profit. Forgiveness amount from PPP first draw loans or any PPP loan, it's not included. And then for nonprofits, if you sell an asset, the full amount of the sales proceeds you do include.
Interesting. That's a weird one.
It is. I thought that was a little strange, but it's just there.
Here's the documentation rules.
Yes, here we go. This is the whole point where we all have to submit and show that we passed the 25% test, right? The 25% reduction. If we're applying for a loan and it's $150,000 or less, we do not need to submit that documentation when we apply for the loan. We do need to submit the documentation then when we apply for forgiveness, if it wasn't included with the loan application. Whenever you submit it, if you submit it now, which I have all my clients just submit it now, even if they're under 150, I have it submitted. Make sure that the first page of your 25% reduction calculation, those documentations and the financials are signed. They got to be signed, and they should have a little statement saying, I test that these financials are accurate. And then it should be dated. Then every other page behind the first page needs to be initialed by the same person who signed. They'll accept a digital signature. What we're doing right now is we're submitting Excel sheets for these. And what we do is we simply print off the first page, which is the summary page showing that we passed. That one, then we export as a PDF, and we have it digitally signed using Adobe or DocuSign or HelloSign, whatever. So they've got that, and we include that with the packet. All the other pages, we just insert a little line just saying it's attested to it, and we have whoever's signing it just type into on each page their initials. And the banks have been accepting those because we go, what else are we supposed to do? You don't want wet signatures. And try downloading an Excel spreadsheet into Adobe and making it a signable document. It's not going to happen. So they've been accepting those. What else do we have? I guess that's pretty much it for this page. Any questions?
Bob, go ahead.
Go ahead, Jamie.
I was going to say, there's a question here that's interesting because I do remember seeing this, and it's from Kathy that says, there are industries that did not have a decrease in gross receipts by 25%, but due to extreme increase in COGS, cost of goods sold, caused by COVID, they are down 25% if you net out COGS. The SBA instructions have referenced COGS, but it doesn't make sense. It looks like that these have not been taken into consideration, but I wanted to make sure I haven't missed any changes. And I think what they were saying, they were kind of working backwards from the tax return of like net income, telling you to add back your COGS to get to gross income. Yeah. So you can't take into consideration your gross profit, unfortunately.
Yep. I'm afraid you're stuck.
Yeah, I think so too. So unfortunately, I feel for them because I'm sure there's. But also depending on, reimbursements don't count as revenue either. So, some people may have to look at how they record revenue in their gross revenue. And if they're doing it for reimbursements of expenses, like some contractors may charge out expense reimbursements or things of that nature. Those don't necessarily count though either, do they, Bob? You should be able to pull those out.
Mm-hmm. Yeah, and
guys.
I mean, obviously, if you've got sales taxes, you pull those out from gross receipts.
Right.
If you're holding money as a deposit for somebody else, those get reduced. They're
Right.
not
Anything
part of
you're holding as an
your
agent.
sales.
Yeah.
Right. Anything you're holding as an agent doesn't count.
Right.
Mhm.
Hey, and Bob, we had a question from Gloria. Hi, Gloria. Good to see your name. If you're a for-profit and you receive funding under a federal financial assistance award, which salaries and other allowable costs are reimbursed, are the salaries that are reimbursed under such an award subject to forgiveness under a PPP loan, or is that double dipping? I would say it's double dipping, right?
Yeah, I haven't looked at that specifically, but the theme going through all this legislation, if you're using the grant dollars, you can't get two federal grant programs reimbursing the same costs, and that's under the general
same
federal
stuff.
law.
Yeah.
Right. You can
Yeah,
use it
so
on multiple things. You can get multiple grants for different pieces, but you can't use it for the same piece.
Yes.
Right.
Yeah.
And I believe all those grants are all coming out of the CARES Act anyway, so that's all tied in together. So it would make sense to me as well.
Yeah.
Okay. How about some of the terms on these second draws?
Sure.
Pretty simple.
Yeah, they are. They haven't changed. It's a 5-year term, 1% interest. Again, if you're, most of us are going to get a 2.5 times our average monthly payroll cost, cap at $2 million. If you are in hotel, restaurants, NAICS code of 72, it's 3.5. And like we talked about, the affiliation rules are waived. But the most you can get as a group is 4 million, which is the last point down below. So if you've got 3, 4, 5, 10 hotels, you're going to be locked in at 4 million. Jamie brought up a great point earlier, which is, let's assume you're sitting there and you've got your staff is everyone's getting paid $100,000 between 3 different companies. You've got to allocate that $100,000 between the 3 companies. You don't get to use $100K in each one of the entities, even if you're on Section 72 or NEICS 72. This calculating your average monthly payroll, to be honest, guys, it's pretty much the same rules. That the big change should be in the seasonal businesses.
Yeah.
If you're a seasonal business, and this is something that's interesting to look at because we're going to have people under these new rules who might qualify as seasonal, because they basically say that if you don't operate for more than 7 months, you're seasonal. Great. Or you've earned no more than 1/3 of your revenue in any 6 months of the year. So if you had someone who had a really bad 6 months last year, though they were open all year and you wouldn't traditionally view them as seasonal, they might qualify for the seasonal rules. And if they do, then you can pick any 12-week period between February 15th of 2019 and February 15th, 2020 for calculating your average payroll. So you could pick the 12 weeks, which are just the peaks. So it's worth looking at. I don't think it will be a common scenario, but that's why when we run these things, I've run them and I ask for monthlies and I take a look at it. And there's nothing in here that I could find that says that those 6 weeks or those 6 months need to be contiguous. So, I guess you could cherry pick.
They did sweeten our included versus excluded payroll costs now too. So they've added a couple things in there.
Mm-hmm.
They popped in that you have group health insurance care benefits and insurance premiums. Those are now included in payroll costs. They did exclude qualified sick leave, which we kind of knew they were going to do anyway.
They were there before, but those are the ones where I think I brought that in there because so many of my clients and so many people talk about, say, oh, here's my payroll. And I say, well, did you have any sick leave or family leave? Oh, yeah. Okay, let me see it.
Right.
Now, if you're using ADP, Gusto, Paychecks, they'll give you a payroll report for this, and it's going to pull it out as long as they reported it and they got the credits for it. Now, if they didn't get the credits for it, then okay, shame on them, and you can just use the money.
Yeah.
Here's
one thing to comment on that, just to make sure people remember, is that out of that health insurance, keep in mind that it does not include 2% shareholder. So I had a bank that wanted to argue with me that we didn't include enough health insurance into the calculation when they saw the bills and so forth. And I was like, no, we're specifically supposed to exclude 2% shareholder. So some of the banks still haven't picked up on that rule.
Yeah, good point.
Documentation is pretty much your 941.
Yeah, this is just your laundry list, and I got a little sloppy here, but what do you need is the 941s. You see at the top left, then the state quarterlies, which is your 1028s, And then what is helpful, if you want to document retirement, employee group health, life, disability, et cetera, if you've got your tax return done, you can go ahead and you could use the numbers off of the tax return. Allegedly, that would be accepted. Clearly, you can also just give them documentation. What has worked for us, and I have not had any pushback from any bank yet, is if your payroll system is actually tracking employers' contributions for retirement and for health benefits, I simply generate those reports and give them to them, and they've accepted those. They said that's sufficient documentation. Let's see, no additional documentation. Oh yeah, if you happen to be using 2019, calendar year 2019 for your second draw loan, and your client also used calendar year 2019 for its original PPP loan, then the bank is not required to ask you for any documentation regarding your payroll costs. Why? Because, you have to go back to the same bank. Why? Because if you went to that bank and you did your PPP loan with them, the original one, you gave them all this documentation. They've already reviewed it and they've already approved it. Therefore, if you basically say, I used the same year, you are the same bank, you've got my documentation, the law says we're good. You don't have to provide any of the payroll docs. However, and I ran into this scenario with one bank where we did that and they said, well, we still want it. Well, they can get it because there's also a portion of the statute that says the lender may request additional documentation.
Yeah.
So
don't necessarily rely on this because the banks are not.
Yes.
Yeah, they are.
Yeah.
That's for sure.
Just play. I mean, it's a great little rule, and you would think that would make sense, right? I would not count on it.
Exactly.
Yeah.
Yeah.
I think, as Alan pointed out in his comments, that they're asking for it, but yeah.
Yep. Updates on the first draw loans. So these are our first-time borrowers. These are the people that didn't apply for the original PPP in 2020 and now want to apply for a first draw loan. They can have 500 or fewer employees. Remember, if we're doing a second draw, it's 300, it's the cap on employees. If you're doing a first draw, it's 500. And if you have a larger employer, you might say, oh, we can't get it. Take a look. There's SBA alternative size standards, depending upon your NAICS code. Notice I got that out correctly this time, Leanne.
Good job.
So thank you. Thank you. At that point in time, that might let you have a higher head count. Expanded eligibility, we talked about this before, they're listed below, they apply. Increased PPP first draw loan eligibility, and I got that too. What do we have here?
Well, you can get more money.
Oh, yes, thank you.
Yeah.
Thank you. Yes, there's additional expansions as to what qualifies. What we talked about earlier. So you can cover all your healthcare insurances, those qualify, et cetera. There's also, so, if that works for you, you can reapply. Forgiveness updates, what do we have here? 60-40 rule still applies. There's been no change to that. An important thing is the covered period. You now get to choose between anything from 8 weeks to 24 weeks. So once you get your loan, you can then say, oh, I'm going to use 9 weeks. I'm going to use 13 weeks. Do whatever you want. The thing to keep in mind is that whatever you use for your payroll, whatever payroll you apply towards your PPP loan cannot be used for qualifying for the employee retention credit.
So it would behoove you to use the shortest period possible to get your forgiveness. Wouldn't you guys agree?
Yeah.
It would. And we'll hit this later. The question would become this. Let's assume that I have $150,000 worth of payroll and I have a PPP loan of $100,000. And I also have $40,000 worth of expenses, which are non-payroll qualified. But I submit my loan and I say, oh, I have $100,000 worth of payroll because I just want to make it easy. and I want to go ahead and I'm just going to apply $100,000 of my payroll against the PPP. If I apply my application for forgiveness with just 100K, because I say the extra 50,000 is more than enough for my ERC, you should be good. But what did we all do in 2020? We all said, oh, I'm using 24 weeks. I'm going to apply of the whole 150 because we didn't think about it. There's no ERC application. I'll put the whole 150 into my application for the PPP. And now it's more than enough to be forgiven. But now we can retroactively use the ERC. The question becomes, well, you included that in your PPP application. Does that mean it's no longer applicable for the retroactive 2020 ERC? Policy-wise, the answer should be no. The AICPA is writing to the SBA and to legislation and saying, no, this is not meeting policy. You can't do that. I fully expect that's what will occur. But one of the reasons I'm telling people right now, just postpone your application for your PPP1 for forgiveness. Let's understand what the ERC rules are because we cannot use the same dollars. And I want to understand exactly what I's we've got to dot and T's we've got to cross so we don't have this battle with the SBA.
Are you saying that the SBA is saying that once you've submitted the application, then that's it? Or are you saying that you can't cherry pick your wages?
Well, the SBA is not saying anything at this point in time. So really what we're doing is the AICPA has gone back to the SBA and saying, listen, in those scenarios where someone has already applied for forgiveness, if they have excess wages, they should be able to apply those excess wages towards their ERC.
Right, and I thought I read somewhere, and again, I don't know if the guidance is true or not. I thought I read somewhere that you can't amend a forgiveness application once you've already submitted it.
Right, you can't.
Once you've submitted it, you're stuck. So I'm with Bob. Don't submit it until you've got this figured out on the interface between the ERC.
But the AICPA is arguing for those that have already submitted it to be able to take that excess and use it for the ERC.
They are.
So that only applies to those that have submitted it. It's again the proper guidance right now is don't submit anything until you look back at your ERC calculation.
Yep. There's one other twist to that. Well, let's assume I've got $100,000 PPP loan. Let's assume I've got $100,000 worth of payroll and I have $40,000 worth of non-payroll expenses. I've applied for my forgiveness and I say, oh, I got $100K of payroll. I'm just submitting it. I don't want to get all the documentation together for the PPP forgiveness. I don't need to. So you submit. Now the question is, should I be able to retroactively, I can't amend my return, but could I maintain the documentation to show that really I could have applied $40,000 of my PPP dollars to non-payroll. Therefore, I really have $40,000 worth of payroll available for the ERC. Again, the AICPA has gone back to the SBA and they're soliciting and arguing that that should be allowed. Obviously, we have the documentation requirements. We should sign an attestation that we qualify for the ERC, but it should be allowed because it meets the policy intent. To be candid, I'm expecting that the SBA will comply with both AICPA requests because it so clearly meets the intention of what Congress wanted, which is to get the dollars into the hands of these small businesses. But we don't know right now.
Yeah. And also the fact that the change in the law passed after forgiveness was started too. So to maybe allow for a safe harbor of those that applied between that and the law maybe.
Yep. Yep.
Yeah.
And remember, forgiveness, not taxable, and the expenses are deductible. So that's been taken care of in the law. Additional eligible non-payroll costs. We won't go through these in detail, but there are additional things which you can use, which qualify to non-payroll. Real quickly, cloud computing, human resource systems, stuff like that, that is included. If your building was damaged and it wasn't due to COVID-19, like you're part of the riot areas there may have been riots or public disturbances and it wasn't covered by insurance, you're good. Supplier cost wasn't in there beforehand, but if you've got basically perishables, so you're a restaurant, you're a grocery, whatever, those can actually qualify before they couldn't as non-payroll costs for forgiveness purposes. If you had a PO outstanding before and I don't remember what the date is, I have to go look at it, those work also. And then workers, if you're buying PPE for your employees, or you're putting processes in place to protect them and meeting guidances or guidelines by OSHA, whatever, then those also qualify. So there's some expanded non-payroll costs.
By the way, don't forget accounting is now included as a covered operations expenditure too. So.
I was reading that and I was kind of looking at, is it saying accounting, or is it all? Because when I read it says business software or cloud computing services that facilitate business operations, product or service delivery, the process, payment, tracking, and or accounting of tracking. So I'm kind of wondering if it's just the software related to those functions and not necessarily the function of accounting. Is how I read that.
It as you can put accounting in there. That was my thought.
Yeah.
Okay.
And I'm more on your side, Jamie. I thought, I just don't want them coming back at me. So I figured I'll pick up all the software. I probably have enough other stuff anyways.
You probably have enough under payroll and other things, but remember, we're trying to maximize the ERC. So
we are.
Yeah.
I can't stress enough that we ought to be really thinking about this ERC along the way. And I've been getting a lot of questions from clients on the covered supplier costs, because there are people who obviously had suppliers during that time frame too. The relevance, obviously, I think we all agree on this, is to get that 40% filled up in terms of the forgiveness, if you can do it, if you can use an ERC. I guess first question is, can you use an ERC?
Exactly.
Then don't mess with it. Just use it.
My first thing is I looked at 2020 and I said, do they qualify for the ERC? If they don't qualify for the ERC retroactively, it's like, forget it.
Use the 941, get out of the way.
You're just done. And then we'll look at the 2021. We've already hit this. If you've got a loan that's 150,000 or less, use the 3508S. It's a very, very simple form. And just what we hit at the bottom, if the loan is 50,000 or less, besides using the 3508S, keep in mind you're exempt from the forgiveness reductions and the wage reduction rules. The forgiveness reduction rules don't apply to wages and FTE reductions.
If there were any CPAs on this line, I wonder if anybody who's a CPA had a 25% reduction in gross receipts in the second quarter the second quarter of last year. And under that criteria, and if it was under 50 grand and they filed their Schedule C, or they had a disqualified entity, I bet you they could go out and get this loan under this special rule in the 3508S.
Yeah.
Just possible.
Mm-hmm.
I don't think we did much billing in the second quarter because we were doing nothing but PPP work.
Yeah.
I was busy with you guys talking the MICPA the whole time. I should have just billed the MICPA is what I should have done. So
I qualified off of that quarter.
Yeah.
and
I made up for it in the third quarter, but I qualified the second. So
yeah.
So yeah, no, that 50,000's a very, that's a nice chunk, because a lot of businesses are going to qualify in there and they're not going to have to do much for the forgiveness. So that was a nice little bonus that I knew about the 50,000 before, but I didn't realize that it was an automatic, no reduction type thing now. So that's a nice piece right there. But at the same time, keep in mind that even though you get automatic on all of that, still look at the 60-40 relationship, because you may still have some payroll that you can use. You just have to document your files. Even though you don't have to submit anything, you still should be able to document where some of the payroll costs are going if you've got that decrease for the ERC.
Right. You do want to take advantage of that. Let's hit on this ERC because we keep hounding on it. So, the original ERC was a credit of up to $5,000 per employee for wages paid. The operations were fully or partially suspended, and there was a 50% reduction in gross receipts. So that was the original part. If you had a PPP loan, you couldn't get the ERC under the original one. But 21 certainly enhanced it quite a bit. You can now get both. Actually, you can get a PPP1, a PPP2, an ERC, and an EIDL Isn't that right, guys? We can get 4 punch out of this punch bowl.
You can.
So I get the credit all the way till June 30th. I have qualified employee wages are now 10,000 to 10,000 a quarter. So instead of 10,000 a year, it's 10,000 a quarter. The credit went from 50 to 70%, and the decline in gross revenue went from 50 down to 20%. I think it makes a huge difference. I think this is one of those stealth stimulus. I don't know, guys. What do you think?
Oh, yeah.
Oh, absolutely.
Yeah.
You know,
Plus,
we keep talking about the decrease in gross receipts on qualifying for the ERC, but there's also that other provision that if you were forced to change your operations or had substantial change in operations, I guess the question that I've seen a couple times come up is what if you force your employees to work from home, and does that count under that second bullet point?
No, there's a specific rule in there that says that if you can work remotely, you cannot be counted. But what it does is this scenario. Keep in mind, if I pass the 20% test for the ERC on a quarterly basis, then at that point in time, the whole quarter is counted. But let's assume it's January 1st and my restaurant's shut down because of an order. I'm not allowed to open. But let's assume that on February 1st, I'm allowed to open. At that point in time, for that month of January, any wages that I pay are going to qualify for the retention credit. It doesn't matter that maybe in this February and March that they're great enough that I don't qualify thereafter. I fail the 20% reduction test. That's fine. As long as I am not able to operate and either I'm partially or fully shut down due to a governmental order. And it doesn't have to be federal. It could be state, which most of them are. There's very few federal. And it can be local. It could be your local municipality saying, no, you cannot do that.
But the exception to that is because I think this is an interesting question for especially a lot of CPAs on this call here. We were all ordered to go the hell home in March, right? We were all ordered but the fact that if we could still work from home during that time period and still do normal operations, we're not going to qualify under that provision.
Right.
But if we were, let's say, for example, a tool and die shop, and we had to shut down because of it, and for those 2 months or whatever, then they would qualify because you can't do tool and die work from home. So that would be the clarification. So, a lot of us professionals that could work from home or had the ability to work from home, our firms aren't necessarily going to get it. But if we didn't, there's a chance that we may be able to, if we didn't, have the technology or something like that, right?
Right. Now, if you're the tool and die shop, let's assume that I get shut down for 1 month. And then the next month they loosen the rules somewhat, so I can partially operate. I can't go at full tilt. If I'm forced to reduce my production because of that governmental order, I qualify.
Yeah.
I qualify for that full time period. If that time period cuts off on March 12th, then March 13th, I don't qualify anymore. It's not like the full quarter. It's for the period that order either causes me to partially or fully reduce operations.
Right.
Okay.
I think that's an interesting, it's so funny because I know that when the ERC came out in the PPP, I kind of looked at the two and said, well, ERC is not going to, PPP is the better option to go. So we didn't really do a lot of studying on the ERC because of the fact that the PPP was the better option for people. And at the end of the day, but for most of our clients anyways, except for the nonprofit space. And now here it comes back full circle to figure this all out again.
Yeah. Now, one thing to keep in mind, and it's right in some of the early SBA comments on this, let's assume that you've got a scenario where my company, because of the reduction of governmental orders related to COVID-19, my sales drop. It doesn't matter. It's not your sales. Sales drops is all the 20% test. It's got to be your operations were partially shut down or fully shut down. Now let's assume your operations are okay, but your suppliers, they cannot get you parts because of a COVID-19. We believe at this point in time that would work. You would say, I can't operate. It's not because I can't run my plant anymore. It's simply because I cannot get materials. And the reason I cannot get them is because of the restrictions on my suppliers. So it's going to be interesting. These are the questions that we need to look at more deeply, and we're waiting for SBA and Treasury guidance.
Bob, I know we've only got about 9 minutes or so. Why don't we talk a little bit about what you and I were talking about beforehand, about the 20% in the quarter, the first quarter and second quarter, the 2009 or 2020 fourth quarter compared to the 2021 first quarter?
Sure. This is a scenario I'm running into, and I'd love to get feedback from everyone who's listening to this, and just pound us with your thoughts too. Under the new rules for the ERC, let's assume that we're looking at, our client says that, oh, if I look at Q4 2020 and I compare it to Q4 2019, I qualify. I pass the 20% test. Well, under the new expanded ERC rules, I could use that quarter. I can use Q4 2020 to see if I qualify for Q1 2021. So we could tell if our clients today qualify for Q4 2020, we could start taking the employee retention credit for 2021 Q1. Let's assume though, Q1 2021, it's a good quarter. If we compare that to Q1 2019, we fail. We don't get there. We can't pass that, the 20% test. Well, the question becomes, now we're in Q2 2021. Do we have to use Q1? Do we have to look back 1 month and say, oh, well, in Q1 2021, I failed the test, therefore I can't use it in Q2 2021? I don't think so.
Yeah.
But again, it's one of those things where we don't think it's a permanent election. We think you could use it for Q1 2021. It doesn't mean you have to use that 1 month look back rule for Q2 2021.
Yeah, so it's not a consistent look back. If you use the look back for the first one, it's not like you have to consistently look back for the next quarters going forward to determine what you need. Right. And I agree with you on that analysis. I think that the fourth quarter 19 applies to how Q1 will work, and Q2 stands on its own under the normal calculations.
I think so. That'd be my guess, but it really is guess with capital G. So what I would do is, I'm not asking any of my clients to start using the ERC, applying for ERC and for this quarter yet, even though I know they qualify using Q4 2020, until we get the guidance.
Yeah, and we can still always go back and amend even into 2020. So, I mean, the nice thing about this is the fact that, unlike the PPP right now, which is more time sensitive, this credit is still got some time to go back and amend returns, and for us as CPAs to do the analysis for our clients and really kind of make sure we're doing it and wait for further guidance and so forth. So while there's a sense of urgency always to get cash for our clients, there's not as much sense of urgency as the PPP seems to take. And to coordinate the PPP forgiveness with the ERC really makes a lot of sense. So, my word of caution, everybody, is just take your time when doing this analysis here.
Mm-hmm. Stacy had a great question, and I have this unique ability of taking a clear concept and making it foggy.
You do.
Yeah, thank you. So the question was, hey, does that mean if I'm using that prior quarter, so I'm using Q4 2020 to say, oh, I qualify. Do I use Q4 2020's compensation? Do I use their payroll for the ERC? No. It just simply means that, oh, I qualify. I qualify for Q1 2021, and I use all my comp of Q1 2021.
How far back can you go with the ERC?
You can go back to day one. So I think it's March 13th, 2020.
Yeah, right. You can go back. Yeah. I think you can go all the way back.
Yeah.
So it's that's what I thought too.
Hey guys, in essence of time, I'm just going to go through a couple more slides here.
Yeah, there's a couple questions on this one, Leon, so it's good.
Yeah. Plus, we want to save some time for the.
Oh, yeah.
Basically, the portal, you guys need to see this.
I definitely want to cover the portal. So Bob, you want to do a quick one on shuttered venue grants?
Real quick, we'll make it. I've looked it over very rapidly. If you happen to have a venue that's a performing venue, there's performing arts, a theater, whatever, or if you have someone who works for, movie theaters, museums, etc., or if you have a representative, a talent rep, they might qualify for it. It is going to be scaled in dollars. It's all based upon reductions in gross earned revenue, so gross receipts effectively. I haven't gone very deeply. We'll have to go more deeply. If people want us to look at it, we can go very deeply into it. There's some new rules that just came out. I only have one client that is a talent rep, and she failed the test. So I haven't gone any deeper.
Let's hit on this portal. I think the portal is pretty important, and I'm going to have Jim jump back in a moment, but this sure makes it a lot easier than any of the prior things we've had to do. So I was going to, actually, I'm going to ask Kevin, if Kevin Riet, if he wants to come in and give us a little bit of an overview of what's going on with this. Kevin, you want to help us out?
I think it was
Brian.
Brian, sorry, Brian.
Brian Sipe.
Kevin,
Brian Syed. I'll come up with somebody here. We'll come up with
Yeah.
Brian Syed from CPA.
Okay. I've been called many things. Kevin is not one of them, so you definitely threw me off.
Sorry about that. That's when I'm looking at 100, 250 people on the screen. I'm going, where'd he go? Where'd he go?
That's right.
Okay.
Yeah.
I'm here. Maybe it's because I have a Chicago Bears cup right now and Chicago stuff in the
Ooh.
back.
Oh, gosh.
This.
I liked you until then.
Hey, listen, we've had some good years and bad years, and it's been downward. So, yeah. Well, first off, thank you so much. A lot of cool things going on with this portal. I'm not sure if anyone on the line has been utilizing the CPA business funding portal. Again, it's just available for. This is for CPA firms or CPAs to help their clients through the PPP process. So, something that we've been working on. With our fintech partner, Biz2Credit. We've been driving a lot of the, so real quick, let me back up for a second. CPA.com, we're the technology subsidiary of the AICPA. This has been something we've been co-driving with the AICPA with the town hall meeting. So I want to add one quick thing with what's happening with Michigan and this meeting, and I work with all the state societies. This is a very unique roundtable that I'm saying that you don't normally see around the country. So just want to thank James and Bob and the team for driving this content. But a lot of great things that are going on with the portal. Again, really at the end of the day, it's about having a proactive approach and having one centralized application tool to help and manage the firm to better assist with their clients. So looks like you have a couple of different example snapshots over here. The portal's been up and running. We're very much involved with the SBA and some of the stuff that's going on. The CEO of the ABA actually sent a letter around some of the issues that with some of the APIs with the SBA as well. So there's a lot of discussions. Cool thing about with the portal is our involvement with the AICPA, that we have some insights that we can help and drive some more of this efficiency. But right now, just for some, we have about a little over a few thousand applications that have been going forward. About 10,000 firms are using this. And one thing I did want to share, this is a free tool that you can use. So I think James is going to kind of send a link. So it's a free access tool. There is a paid version. So one of the things that with this process is, CPA firms, they can receive agency fees as well as bill for advisory service as well. That's some of the stuff with the paid version. It's a very minimum payment. So it's, I think, less than $1,000. Through this process, CPA firms can actually start earning agent fees through this process as well. So not sure if there's any other slides over here, and I know James will send the link. So again, take a look at it, free tool. We definitely have some Michigan firms that are utilizing the tool right now. I'm not sure if any of them are on the phone or on the line right now, but James can share my contact information if
Yeah,
I can help out.
I put a link to the tool in this chat, but in case you can't copy it right now, there will be materials that go out with the entire presentation to everyone today. So you will be receiving an email by the end of the day today with a replay of today's program in case you want to reference it, as well as the presentation, some things from Brian. I know everybody's really busy this time of the year, so the nice thing about the portal is you have this added layer of PPP2 to deal with in a very busy tax season. This portal, the tool, the biz to credit relationship can kind of streamline this and make things easier. So I would suggest take a look at it, use it. I think you'll find it very valuable. I want to thank Brian for joining us today and
Yes, thanks,
participating.
Brian.
And of course, Leon, Jamie, and Bob. Excellent content. Everybody, I would again ask that you go to our MICPA Connect page to continue the conversation. I'm going to post that in the chat as well. You can copy and paste that link or click it now and go right to Connect. If you haven't already started taking advantage of this member resource, it is a great tool to communicate with each other. And you see a big audience today. We had over 250 people. We had 350 people on January 5th. That's a large group on a large brain trust to share ideas with and bounce things back and forth off of each other. As new guidance comes along, as things change, I would highly recommend using that tool. And as always, if you need anything from us, the association, we're here to help you. We're celebrating our 120th anniversary this year, and we're really focusing on the impact that CPAs and the accounting profession have made on Michigan. So thank you very much for participating today and for your membership. And as always, if we can do anything for you, please give us a call.